Today we are going to have the fourth session of the our second phase, and I will cover technical analysis. Now, so far we were studying about economy, industry, and company analysis, which is part of fundamental analysis. Another way is looking at technical analysis. There are differences between the two. We will discuss about that. But let us go deep into it. One thing I would like to say in the beginning that if you try to follow technical analysis, please go deep into it because there are many people, there are many technical analysts in the market who are using technical analysis in the equity research firms, giving you daily calls, positional calls, etc., and that they are quite successful. Now let us start. What is technical analysis? An introduction. Technical analysis is concerned with critical study of daily or weekly price volume data of the index, like Sensex or Nifty, or a particular stock. Why index on Nifty? I said first because since it is an aggregate of 50 stocks, it gives a better indicator. But you can follow the same thing for a particular stock. Now, so far what we have learned that you should know about the GDP and etc etc. You should learn the industry, the competitive forces, a lot of study. But technical people are saying no need of all those things. Just watch the daily and weekly the price and volume, how much people are buying and selling, and what is the indication that is giving. Okay. The objective of the technical analysis is to predict or forecast the short, immediate, or even long term price movement. It uses only the data generated from the market. So it is using no other tool but a lot of tools. In the sense, it is taking the data points of how when there is some movement, somebody is buying, somebody is selling, at what price the deal take place, the next at what price the deal strike price, then there might be a big buyer. Somebody is buying for the short term, somebody is buying from the long term, and etc. etc. So if somebody is familiar with the stock market, they will find that the morning first hour or up to lunch or before lunch, there's a lot of activity. Then during the lunch and other thing, there is less activity, and then before closing, there's a lot of activity. That is because many people they buy or sell in the morning and they want to square off, we call it. They want to sell, do the reverse deal in the evening. Similarly, there are many buyers are there who are fundamental buyer. They don't wait for the time. They, as per their plan, they can buy from the market and etc. Let me focus on the technical analyst, how they will be using this data. The market value is determined solely by interaction of supply and demand. Now, economics, you have all studied. The market price is nothing but demand and supply. Supply and but supply and demand is governed by numerous factors, both rational and irrational. In case of typical economic product, like suppose salt or sugar or things are different. But the moment I will talk about onion or tomato, the supply and demand is governed by numerous factors. How much the production, what is the rain, etc., etc. So rational buying people are generally buy rationally, so there is a price instability. But then sometimes people are irrational. There is a rumor that there is a very less tomato has agricultural crop has come up or very less onion has come up, etc., etc., and there is a huge demand in the market or there is a no stock in the market, so the price goes up. I'm not talking about this is the irrational way of looking at it. Like, so same thing happened in the stock market. Also, there is a lot of irrational behavior. People always do not behave in a rational manner. Stock prices tend to move in trends which persist for an appreciable length of time. Generally, stock prices move in a trend which persists for an appreciable length of time. So people are buying, people are selling, people are buying and selling, but on the whole, at the day, Maybe 30 people have bought, 20 people have sold. Next day, 40 people have bought, 30 people have sold. The overall, there is a more selling, a more buying than selling. So the stock price will start moving into upward directions slowly. It may go on for some time, or it may not go on for some time. Okay. Changes in trend are caused by shifts in demand and supply. So this is quite simple. The same people who were buying, and now if they start selling, and those who were selling, if they start buying, there will be change in trend, and of course that will reflect in the price. Shifts in demand and supply can be detected through chart analysis, and some chart patterns repeat themselves. Now, shifts in demand and supply, some intelligent students may ask me, the equity shares are floating, limited number of equity, limited in the sense a fixed quantity of equity company sells in the market. So, वही the question of demand and supply में shift क्यों होता है? Why it is there? Because sometimes institutional buyer or domestic buyers, they corner or they buy a lot of stocks. So the floating stock in the market comes down. In that case, what happens? A little bit of buying or a little bit of selling will change the price abruptly. So that you can find from the chart analysis, because in the very beginning I told that in the very beginning that we have shown you the technical analysis is concerned with critical study of the daily or weekly price and volume. So volume is also another thing which we have to keep an eye on. How much volume a particular company shares is being traded. Now, just a minute. So now let us move to the next one. There's some difference which you should be aware in the beginning, fundamental analysis and technical analysis. Mein. Focus on timing and likely price changes in technical. Whereas in fundamental, I am the right side, this side, this side is fundamental, this side is fundamental. This side is fundamental. Okay, if somehow or other it's not working, and this side is technical. This side is technical, and this side is fundamental. Okay. So now, so this size is fundamental, this size is EA. So now what happens is that, sorry. So you clear this side. Oh my God. Huh. As you see it, the left side is focus on timing and likely price changes. That is the technical part. Focus on valuation of intrinsic value is the fundamental part. Price target or forecast. Whereas in fundamentals, focus is on price target. Look, here I am not telling about the buying price, the target, but that's also important. But I am telling that this is going to move up. So, lesser price I buy, I have a margin of safety. Suppose I buy today, this is not a tips. Suppose this is buy today a stock like Aditya Birla's Grasim, sorry, I build retail and fashion. So I may buy at a per X price, and then I expect a X plus 100 or 2X or 3X. At that time, I will get it out, maybe 7 years or 8 years, like that. My study says that it is possible. So this is the basic difference in fundamental and technical. One is taking all the data. One is taking all the data from the market and trying to form an opinion. One is trying to taking all the data from the external sources and forming an opinion about the future, which is a little long term. Here it is short term. Also, these short terms can make a medium term to long term also. Now let us come to the charts and patterns. Now, as I told you, the price movement they try to understand what will be the movement of the things. So it has no time. There is a very old method was there. Even now, that is integrated into the modern checkup. Point seven finger. There are four assumptions are there. It has no time dimension. I keep watching and take the data, then I may not take the data for some time. Then again, if there is a change in the pattern I notice, then I take the data. It disregards small changes in the stock price. That's what I was telling. Suppose ITC is going for 102, 403, 4, 5. I'm not noticing. I have taken the data at 405, but it has gone 410 up. I take the data once more. So there is a time period which is arbitrary for me. There is no time dimension. Price is the factor. It requires a stock to reverse direction a predetermined number of points. So the second or the third thing is that at what point 424, looking at ITC 402, 403, 404, like that, they are moving. क्या हो गया? Hello. So what has happened is that it requires a stock to reverse direction a predetermined number of times. So 402, 3, 4, 5, 6, again back 3, 4, 2, like that. So we try to see the reversals, how many times it's happening. And before a change in direction is recorded on the chart, at what point it changes direction. 402 to 406 it went, then it changed direction, again lower side. Again it went up, 408, it changes direction. This is point seven finger chart. That is how it is done. But the most popular, which you have very much heard, is bar chart. It contains measure in both axes. One is time. You can see 13 June, 720 weekly, and one is price. Now here, if you notice clearly, there are. This is if you notice here. Sorry. If you notice here, there is a opening price, then the price goes up, there is a high, there is a low, there is a high, this is high, then this is the closing price. Am I clear? There is a opening price, somewhere it will be there, opening price, then it goes to top, this is the high price, then it is comes to this was very close to lower price at which it has closed. So there are in this will be the better thing if you can observe properly. It is the maybe opening price, either it has gone high this, it come down to this as a lower price on that day, and then went and closed in this. Yesterday also it was closed at that time. On this day, it has closed at a higher level, maybe. These two are the higher level closing. So they, as I was telling you, the point seven finger made, I am observing the stock, how high it is going and then it is coming back again, or how low it is getting closed. Okay, someday there may be sharp drop, whatever the reason may be. So another factor here is that, we have studied earlier in our first session that various information keeps coming during the time when the stock market is open. So how the stock is reacting or the index is reacting to this also matters. So that also noted by this technical analyst. Now there is next another chart we will see. This pattern will be very important for you. Japanese also it is called. This is basic character of a candlestick chart. Now here you see the opening price. This is the main body. The price has moved. This is the closing price. Upper wick or shadow, lower wick of shadow. This could have gone this side. This is A. It will be a green signal. This can be a red signal when it is bearish. That means selling pressure in the market. So this is the basic structure of a candlestick. I wanted you to be aware of it. So once more I repeat, bullish candlestick may closing price is the top, opening price is the bottom, and the body is this. The price is moved around that. It could have gone upside this. होता है ना कैंडल का, the flickering light goes up. It is something like that. This is the lower flickering and this is the upper flickering. But this is the main body in which the price has moved. Similarly, when the market is down or the stock is down, it opened at a lower price, went down farther to a lower price, closed. In between it was here only. Maybe for some reason it went up like candle ka flame, up and down. You have seen candle flame up only. Assume that it goes down also. It goes down, and then but it moves mainly between this opening and closing ka andar mein. So that is why this is a little bit of width is there. So this is the broad area in which the price has moved, candlestick. Okay, somebody calls it Japanese candlestick also. So this is another way to represent it. Now will be your interesting part. Now this is Nifty daily chart. Okay, so point and figure chart I was telling you in earlier point and figure chart. Sorry, it is 7. It should have been and point and figure chart. And then percentage of stocks from Nifty 50 universe that are trading in a column of 10 in point and figure chart. Column of 10 is here, but overall market has moved. This is the Nifty movement. You focus on Nifty movement. That means on this for a time period. This is 1, 2, 6 month year to date. Another thing. 9th August, 26th July, 12th July, 28th June, 14th June करके March तक है. So March का on a particular date it went up. I told you, you don't notice every 16th, 17th, 18th. You notice also, but you don't reflect it here. And then it has come down. So when it came down, if you see it here, broadly it has moved here. Next day it moved down. Next day again it tried to move between this. It could not move up. There is a flicker, but it was there only. But next recorded day, it has gone farther down. Next day also it went farther down. Okay. But on the 4th day, suddenly it has shown the buying signal. Market was good. So it has gone, though the lower price, but there was buying in this price. I'm selling in this price and there was buying in this price. Remember the thing? If it is green, there is opening price and closing price is high. So opening price was low. That means yesterday's low जो था इससे भी लो में ओपन किया है but closes at upper price में. नेक्स्ट दिन गैप देने के बाद इट हैज ओपन फर्दर अपर प्राइस में. दिस इज ओपनिंग प्राइस, दिस इज क्लोजिंग प्राइस दैट डे. Again it moves down. So you get a pattern of this movement. Further we study, we will understand more. So these are the called candlestick. These are the daily data. Now question is that technical analyst के लिए these daily and timely movement are the main input data that they are recording it and they are observing the movement of the thing, how it will move later on. Okay, now let us see what is the next one is we come to the Dow theory. Now Dow is the founder of this technical analysis. What is important is that it says understand the market trend. Market is basically bullish or bearish or flat. If flat, there will not be much movement in the market and etc. Identify when the reversal is taking place. Stock is going up, suddenly stock is falling. Or stock is falling, suddenly stock is turning and going up. Observe that. Confirm the trend. Look at this. Market trend and this trend. If market is downwards and you see the price is falling and then you confirm the trend. Now the foundation of technical analysis which we'll further study, identify the reversal and from there you will understand the long-term perspective of the stock, whether it is long-term it is going to fall or it will this fall in for a period, for the time being. Maybe the rainy season it will be down for 2-3 months, then it will start moving up. So this you will be realizing when you do a more study on this, but few stocks or indexes. Now Dow theory has, it is a index, this is index value and investing years. Over various years they have taken. So the index has fallen. Then suddenly invest has gone up, again came down, again gone up. You see two bottom up and two bottom down we are finding here. Down has come, then again it went, but it broke these two tops. When it breaks the two tops, it expected that it will be having a uppish run. How long you cannot tell. You have to observe. So you see here, the market goes up and then temporarily it falls, but it does not fall this line, which sometimes it is called support line. It does not fall the support line, it again goes up. Again goes up and goes high. Now this is the resistance line. So here पर जाके again buyers are little scared. So or somebody who has bought at this price or this price, they are booking profit. So price starts falling. But interestingly, price starts moving up again. So it didn't fall like earlier time. So the support line which was here, if I take it called support line 1, this is the support line 2 which is upper. That means markup phase has begun. Market has begun the bull run or it is moving up. Same thing happened here. Reaccumulation in this phase because you know basic trend is uppish. Only thing is what is happening is a temporary corrections in the market. So many of the fundamental buyers accumulate this time. Also technical buyers accumulate because they know the market is going to go up. And then you see market is never coming to this support line. Market is gone up, Now this first time market has bottomed, then also it didn't, but it has gone, it is sounding something. In the meantime, market has not moved up this up. After that, twice market went to go up. Two bot are up, three up, four up, but market is, so this is the resistance again. So there was a resistance here, small resistance, there is a strong resistance here. So this is the time when somebody can better to sell the stock, because it is an indicator. After the two falls, then market falls, the indicator line, and in fact market breaks this line also. So that means market will be in the downward phase now. I will not say this is a bearish phase, but maybe this downward phase will log for some more time. And as you see, it falls again, it goes up. So many people gets bullish. Arey, फिर दौड़ेगा. But it doesn't happen. It again falls, and now it falls below this. So every time when it falls below the earlier phase, the risk increases. The trend is saying that it is again, it will be down phase, and then again it tries to go up, falls to bottom, to up, but could not reach this. So again it falls. So this is the beauty of Dow theory. After observing this bar chart and candlestick charts, if you accumulate all those things and draw this graph, you will find these things, and you will find the phases when you should accumulate, and then you may sell out, then you may again accumulate same stock, and again you may sell out, because this is broken. You can see, you can wait, depend on your nerves, then you can see the whole, then you can sell it here. It's not necessary you will be selling at the top and buying at the bottom. Sometimes you'll be selling in the here or here, like that. And this is how the market moves. Market is never unilaterally upside or downside. Even if it is unilaterally upside, in between there will be some correction phases will be coming, because some people will book profit at a particular, because they have achieved their target. Okay, and then this will fall, and then there will be scope for some people to enter the market, and then they will buy the stocks now, and they will also wait for this. They will buy the stocks now, they will wait for the breakout, because the overall indicators is it didn't touch the support line, so it will supposed to be going up. This is did not touch the support line, so it is likely to go up, so he will be holding the stock. So now, depending on his NAR and his profit, generally you have a profit idea in the mind कि this much profit होने सब निकल जाएंगे, and somebody is ready to wait till the market totally behaves and gives the indication कि now it is better to sell off. The market will be in the lower, market will go down further, so you may sell out. But those person who has bought here, he may wait, because he may think again it will go up. So this is the what the behavioral part in the market works. But an intelligent technical trader, they have a stop loss and upper maybe when to sell. That idea they already have, so that they are never below this line or they are never above this line का expect करता है. In between they try to buy and sell and get out and make some money, of course. So this is Dow theory. Now there are certain patterns I will show you, which will give you the other terminologies which is used by technical analysts. Head and shoulder. Now the formation is encountered when a bar chart forms a hump. A bar chart, these are bar charts, forms a hump followed by a peak. Okay, followed by a peak. Look at the hump, and then there is a peak. And then another hump. Maybe then it will be another hump it will get like this. If you can, if I put a red line here, it will be going like this. Okay, or here if you now put the graph, it goes up, then there is a fall. Goes up, then there is a fall. But head and shoulder, as I was telling you, now if this is the neckline, that means support line, then twice it has fallen. Once it has gone to the top, but twice it has left side on the right side, it has gone up to almost the similar level. So this is an indicator, a line joining the lowest point of the humps or and the peaks product a resistance line, as I was telling you, resistance line which forces a market. So this, if I touch these two, then there is a bearish market. Again, B and G here, the top maker, they are saying it go down. And reverse head and shoulder formation is the opposite of this. Reverse head and shoulder formation, reverse head and shoulder is this. So there are two. Suppose this is the bottom and this is the two. So it's too far off actually. This is the. I hope I can make you understand, but I would prefer to tell you like this. Suppose it has fallen to D and here it has come up to G. So there are two things and then it is again going down. So there is a bearish trend in the market. So this I could have given you another example showing the reverse side of it. So one is the very careful you should be when you are technically playing the market or technically you are a technical trader, because they are not investors. They make money in the short term. It can be medium term also, 3-4 months. So the neckline is important, because when the neckline is broken, you have to be careful whether you should sell and get out or not. Now you need not sell here if you have bought here, but if you have again crossed it and then the G has started, then you should better, whatever profit you have, you should take and get out. But these two shoulders indicate there will be a downturn coming. Double shoulder हो जाने से. Similarly, नीचे double shoulder हो जाने से there is a upside का chance होता है. Let me see the earlier one में. No, both are ये. हाँ, नीचे double shoulder हो जाने से, नीचे double shoulder हो जाने से upside आने का chance आ जाता है. नीचे double shoulder हो जाने से upside आने का chance होता है. Double shoulder and one peak हुआ था reverse में. So now again upside जाने का chance रहता है. So this is called head and shoulder. Now I move to triangle. The triangle is, let's read the first few lines. These are formed when the peak point of descending tops, that means top पे पहुंच के closing top गिर रहा है every day, fall on a line, as well as ascending bottoms fall on a different line. माने लोअर में जितना बंद हो रहा है, these are falling in a different line. If I join both the lines, this will point to a future. Now here, if you see, these are the bottoms. I have connected it. And also these are the tops. These are the top. This was the top. I have connected it. So this is a triangle. Now what happens is that if it breaks the upper one and moves out, there can be further upside for this stock. Look at this here. Ascending cycle. Trader will enter into the long position on a break above the resistance, and then depending on his profit motive, he will get out. And similarly here, if it is down, traders will move into here, they will sell short, and then they will try to buy at a lower point where they think they can make profit. So since our market may now you can borrow stock and sell, but in the derivative you can very much use this one. But be careful, if you are using technical analysis, don't take only one parameter, study the other parameters also, volume, etc., etc. Okay, so this is called triangle formation. This gives a very good idea to the short term to medium term trader when to get in. Now, this breakout may, when if I get in, I may be here on 5, 6, 7, 3 months before it starts breaking, and or there is another formation of triangle starts, and I find I am breaking down. I'm in a descending triangle. I can sell and get out. So this price movement, again there is a price movement, and then there might be price movement now like this. At this point, if you put it here, and if you assume this is the next movement, then you have a time to get out. So you should get enter here and then you get out. And that may take 6 months, 5 months, 3 months, etc. That is when the moment market goes down, don't think market is crashing, and don't the moment market goes up a little, don't think market is booming totally. Maybe market is moving within a parameter before the real boom or bear phase starts. As of now, I am not supposed to give advice. So be careful about the market. And if you notice that, okay, market is basically having a trend, then you can take advantage of the trend with a disciplined profit booking idea, and what price you will get in and what price you will come out. That's very important, right? I will just give it a time with some water. So these triangle formations are very good indicator to know that whether I should be getting into the stock, and if by chance there is a later after 3 months or after 2 months, this type of things, no, just because I'm saying 2 months, it may be 2 weeks. So you have to keep watching whether there is another triangle being formed from here to here, like this. Another triangle is forming. Sorry. Another triangle is forming or not. Okay. So that's the thing you have to keep an eye. So let me go to the earlier chapter. This is also a very important head and shoulder pattern, from where you know how to where to enter or when to get out. Always remember, you cannot enter at the bottom or exit at the top. You have to understand the trend, and then you have to take your call. Should you enter, and at what price you should get out? Next. This is called relative strength index. I'll come back to those slides again. Relative strength index. Now, this emphasizes market moves before they occur. Actually, if you're watching the market, many people who are very seasoned player in the technical market, they can tell tomorrow market will open higher or open lower or open flat, like that. Why it is? When the price of a stock advances, the closing price is higher than the closing price of the previous day. Then you know that market may open higher. I repeat this line. When the price of a stock advances, so the price of the stock is advancing and closing higher, then you may expect that the market will open higher next day. Okay. The reverse is also when the price of the stock declines and closing price is lower than closing price of the, that means प्रीवियस डे में लास्ट मोमेंट में भी कुछ आदमी आके बेच दिया और जो लोग नहीं सका टुमारो मॉर्निंग में भी दे विल सेल सिमिलरली if the price is going up you don't want to miss the bus so you may not be able to buy at the closing so tomorrow morning the first thing you will try to buy the stock before it goes up. This is the behavioral pattern of the people in the market, which drives the market. And because we are taking the price points and time, we get these things. So now from here, if you look, after these two bottoms, market is forming a upward turn. Double bottom pattern with RSI. So relative strength in this, because of the after so much, there is a double bottom, but that's a big double bottom and with full confidence bottom. Okay, and now it is going up. It opened up then that, it opened up then that and closed up. Little correction in between also will happen, I told you. Even if the trend is uppish, there will be small correction may happen. Again, it opened. If this is the graph, you remember this was the closing price. It opened lower, but it closed. Next thing again, it opened at close price, then closed lower. Next thing is closed lower farther, but then it opened here and closed higher. And then it closed here, it closed higher and went higher and went higher and went higher. In between these things, the small corrections, small adjustments were happening. Some people bought profit, they want to get out another thing. So these minor things, technical analysts are not, doesn't take bother that much. I told you in the very beginning. There are three types of trends. The minor trends we do not bother that much because we are basically focusing on the stable trend. So you find that from here the market is basically going up, up, up. So if you enter here, you can have a nice ride, but be sure that you can sell before it comes down to this level. So you may be selling somewhere here and make profit. That is how the relative strength index is used. The market is up. Now here it is again down signal is giving. So if you have nerve, you can stay, or if you have bought somewhere here, it is better to get out somewhere here so that you make the profit of this. Just go through the picture, you will yourself understand what the picture wants to say. Time permits, I will have a rerun of a couple of slides so that you can understand and you can focus on those areas. Please write it down also, the slide names or slide image of what I am trying to say, so that you can refer those things in your book or in the. Please don't visit any site without knowing the reliability of that site. Now next. So it is clear, this is relative strength index of a double bottom. Now we are coming to, you might have heard any time 50 days average, 200 days average, like that. Now why it is? How to trade using the moving average crossover strategy. Okay, MACD they're called. This is MACD. Now select moving average. Use one short term, that is 20 days, 150 for swing, and 5-minute and 15-minute for intraday. This is what this gentleman's opinion. I will not, this is not my opinion, that is disclaimer. It's the opinion of the person, I'm forgetting his name. Select moving average. It's very important. Actually, you will develop the expertise when you are in the market and you are doing technical trading for some time. In the meantime, you can take uh, proven technical analyst guidance. They are a registered advisor by SEBI. You should listen to them and form your own opinion. To select AMAs, use short term और long term and intraday के लिए time भी बता दिया. Within that you have to get in, go down and choose trading style. Decide between intraday swing or long term to pick suitable time frame. As I was telling you, decide between intraday swing. Swing मतलब गिर रहा है तो हम खरीदेंगे, नीचे जाके बेचेंगे. I am watching the stock, but I am waiting for the swing to come because you might have missed the first one. Or I am looking at the long term, like I told you here, the long term pattern I am looking at. So keep watching. Don't be in a hurry. Have patience. Okay, dheeraj rakhna. Or wait for a crossover on the chart. But when the short term average crosses above the long term, so when the short term average crosses the long term average, so 50 days average is crossing 200 days average, then it is a time for a crossover. Step 5, step 4, confirm the signal. So step 3 is what I told you, 50 days average is now cutting across 200 days average and going up. So now confirm the signal. Also go to the RSI, double D, or other thing हुआ है कि नहीं, and MACD as you will learn, to volume to validate the trade. MS or volume, big people are, or big amount of stocks are moving like this. They only can move the market. Now you have to decide whether I will, whatever position you are here, you want to buy or sell based on the crossover direction. Crossover direction can be downside, can be upside. So depending on what type of position you are comfortable, you should enter the trade here. Set a stop loss. If you want to make money in the stock market, take this advice, which I'm not supposed to give. Always have a stop loss so that your capital is not totally wiped out. Below swing low for buys and above swing high for sells. So as I showed you earlier, the resistance line or the bottom line or in between some benchmark you should have, which will be your stop loss or your stop gain also. But stop loss is very important. Gain, who doesn't like? And then finally is plan exit. Plan exit. Set target or use a trailing stop. Exit on reverse crossovers. Trailing stop matlab hai, suppose I have initially decided if ITC goes above 465, I will get out. But you find 465 say 463 aake it's again going up. So you may enter and again you can again, that is what is trailing stop. Or sometime you know that okay, it is moving up. So I will not sell now, let it further, then I will increase my sellings. Even when it is going down, suppose I have given some stock is going down. Let me see, I have a chart like this. Suppose I have taken this stock and I have taken this stock is going down. I have purchased here. I have purchased here. It is going down, going down. But I may not decide because I think just somehow or other it is hitting the bottom. Now anything hit bottom has to go up. So it starts going up. Even now I am thinking, shall I sell? I have not got my price, so I'll not sell. So I'll wait for here. I have got my price more or less, but still it's a small indicators. But I will see whether it forms a double bottom or not, or it is going high or not. I can sell here, but then I can again get in if I see the price is falling, or I can get in when I see there is a double bottom and it going up. I can again get in here because I know this is a strong RSI pattern is showing. Am I clear? So this is moving average crossover strategy. It's a very important rule. So RSI, I will sum it up later on again. Now MACD buy and sell. This is the MACD moving average as it moves. Now I am showing some particular stock. Okay, this is exponential moving average. This moving average data will be called exponential hoga. So this is the going up, going up, going up. But now you are saying it is flattening. So you sell. This is, see, you are selling at a much lower point. I told you, you may not be getting the top all the time. So sell because now the fall is quite a big fall. So you are getting out. Why you are expecting? Because this fall, it could not go up, went less, then it fell. So you took a precautionary stance, you sold. And then when it comes down, this is also called bottom up overbought, sorry, bottom up. And then again you can get sell time. You can buy from here. Again you can sell here. You didn't sell here. You sell here. Again you come here. You can buy. So you have to keep a watch on the market and you have to see the trend, and the most important, the stability of the trend. So what is important here is that minor trend don't get carried away. तब आप बेचोगे खरीदोगे ब्रोकर कमाएगा, but you should have the nerve to wait and watch the trend is solid or not. But have your stop and loss in mind. If your stop loss is here, then you get out. If you have bought it, your stop loss is here, then you can get out here. But if the market is moving up, the trend is good, trend is good, trend is good, trend is good, but now every good is not so good. You know, the green is getting shorter. Green was getting longer, now it is getting shorter. Not confident, huh? So you know that I should get out. So you can get out. So you make a money between here to here. This is important. So this is how you use MACD, moving average, in an intelligent way. This is a overbought, oversold. This is too much. A lot of data has been punched together. You can see here, 1st January to 193 has been touched here. Sorry. So this is the buy and selling, this is the selling. If you see here 91, 93, 94, 95, so a lot of movements are there. So I see this, and throughout this period 90 to 99 market, it has touched the bottom, but still it has not broken. After this it is trying to pick up. It is trying to pick up. It's trying to pick up. And it has picked up. Now it is picking up. So we are into a long upward trend. So you can get in and you can remain, or you can think of. But when it has broken and it is going up, you have to be careful, because this up mein jaake it is unable to cross. It is unable to cross, it is started falling. So somewhere you have to get out, because you know it is overbought zone. Sometime Indian stock market was overbought, so foreigners were selling and getting out. So you will situation in this market, you make money, but you don't want to lose money. So be careful about the overbought and oversold zone. This is a little different from where you are moving out and moving on. It is generally for the long, and it takes time to be overbought and overall. The longest time it takes. Now let us see the Elliott wave theory. This is one of the technical analysis pioneer. This tool used by traders to forecast market trends and identify potential trading opportunities. Be careful about Elliott wave theory, and you can draw your own graph. Elliott wave theory is a technical analysis tool used by traders to forecast financial market trends and identify potential trading opportunities. It is based on the idea that market trends and movements follow a repeating pattern of waves. Please note, repeating pattern of waves. So if you miss one wave, don't jump. Wait for your time. Patience is the key. So if you have seen this bounce, and here you are thinking, I market giriya, bekar, I could not make money, another thing. Wait. Maybe at this point it will again bounce back. So let it cross the earlier point. Till then, some people get in another thing. I am not interested in these shortcut people. These are minor, but if it is confident, then it will go higher than the earlier one. You should remain here, and you may get out when you have made your money another thing. And then it falls. And then you see that there are double fall where it broke and fell down. So before that, you should be definitely out at this point. You get my point? Because this push was there, but this push was much higher. If you look at the length of this arrow and length of this arrow, then the fall was equally good. Up was not that much strong. So when it was falling, you can start selling your stock. So this is what technical experts are saying. They're saying the market trend and movement follow a repeating pattern of waves. So wave 1, wave 2, wave 3, wave 4, like that. That is what is mentioned here. Wave 1, wave 2, wave 3, wave 4, wave 5. You may not make money in wave 1 or wave 2, but if you are patient and have discipline, you can make money in wave 3 or wave 4 or wave 5. So let us sum it up. Or so everywhere you are seeing a pattern which is basically market goes up and down, so down and up. You have to got the trend. So MACD, RSI, and other things, you should be remembering these slides very well. When to trading style you have to choose and how to decide the intraday swing. Then you have to decide your, or you have to listen to the experienced savvy technical analyst, and then you should decide your crossover point. When the short term, it can be 2050, it can be 5200, which many people like 5200, and then you have to decide from this strength, how strength is the signal. Signal strength should be like this. Okay, short term it should be like this. And this type of wave you will keep getting. Now in a bull trend you get this type of graph. In a bear trend you get this lower side of the graph. In both sides you can make money. An investor, technical analyst can be winning. But the main two things are there. You have to keep what price you will get in, and what should be your stop loss, and what point you should get out. Now, get out way you can move your stop loss because you are making money, but don't get out of your stop loss even if you are moving up. I'll just tell you something. Suppose ITC has gone to 402, stop loss is 389. Don't sell. From 402, it may go to 404. From 404, you move it to 402, the stop loss. Then it goes to 415. You move to 408, stop loss. So 398 to 308, 10 rupees you get extra. So this is what is the stop loss and other thing concept. So let us sum it up. In this unit, we have discussed technical analysis approach to predicting share price behavior, Dow theory, which is from Mr. Dow, originator of technical analysis, basic tenets as discussed, and classical charting techniques, point and figure chart, bar chart, and classical formation. Based on this, all the charts, triple top, head and shoulder, triangle, support and resistance, all these things I have discussed. Please go through it. And the technique of modern, that is relative strength index, rate of change, moving average, convergence and divergence, as I told you, these techniques are now modern techniques, and further modern techniques are coming because statistics and analytical tools are now with AI is very fast. So you have to be updated if you are in technical analysis, but because things happen just like that, because the information flows to the market and it affects the price, and the price can go up, price can go low. Don't panic with a sudden up and sudden low, because if market goes up, it will come down. If it goes down, it will come up. You need to have your own stop loss and own strategy. With this, I thank you very much, and tomorrow we will go for valuation again. Thank you.